Good evening. Dan Fitzpatrick here, stockmarketmentor.com, and it is Tuesday, October 9th. Just a quick heads up for members. Tomorrow morning, I'm going to be trading the open. We're going to do that in live webinar format, and I want you guys to be there if you're interested in active trading. Frankly, this is the only kind of market. It's the only kind of trading that's making money these days if you're doing it right. Just so many trends, and we're looking at Costco here as an example, are ending, or at least bending, as the saying goes. So to be in trades for a long period of time, you're really kind of throwing your fortunes up to the market gods, which you don't want to be doing. So I'm going to be teaching some techniques for trading the opening rotation tomorrow morning. If you're not a member, just sign up for a trial membership, and then you can attend that as well. So you can check that out. It starts before the market opens. Gary, my brother, will be sending you guys out a link. Now, let's talk about Costco. Reason is because the time, at least for me, that's worked best for shorting stocks is not when they first plunge down here like we saw a couple days ago. Let's get back to it. You know, a lot of folks, a lot of retail traders look to short stocks here because they think, okay, well, this is a trend line break. I'll short it here and cover at 205 at the 200-day moving average. Or they just kind of get, unicorns dancing in their dreams and think the stock's just going to keep going down. But the bottom line is, what happens in a situation like this is some folks that are short will cover in the same way that a breakout to the upside is going to prompt some profit taking on that. People that were long the stock, they see the big move up, they're going to sell into that, and that kind of halts the uptrend. Here, the stock gapped down and kept going, and you're going to ultimately, at some point, whether it's here or down here, by the way, we know where it is, but it could be here or down here. At some point, shorts are going to cover and say, you know what, I'm going to take my money and close out this really nice short. And at the same time, dip buyers who were waiting, couldn't buy up here, they see the stocks finally down at a price that they can afford to buy, that they can reason that it's a good time to buy. They're going to go ahead and start taking the stock. And so that's what we saw. You even see this kind of reversal in a stock like Tesla that just had every reason to go lower, and ultimately, guess what? It goes a little higher. It's what happens. Value buyers come in, they buy the stock. Short sellers close out their profitable positions, and then you've got a stock that's in this situation right now. So the deal is, if the stock does not rebound strong right up here, then what this shows you, what it reveals, is that there's a lot of selling pressure still to be had, because anybody who's buying this dip now, they saw it at 220. Oh my gosh, I got to load up on this. All they're having to pay is up $4, and that's it. In other words, there's plenty of supply for anybody who wants to buy Costco. And I say, after a trend break like this, a lot of the guys that were going to buy the stock have already bought the stock. Now they're selling. So the idea of selling short is that you're not in the stock one way or another. You see the stock break down, and you do not short. You watch, and you wait to see if you want to see the stock return, try to regain its former glory here, up above the 50. And if it doesn't, boom, that's when you short the stock. You short the stock because your thesis is that there's more supply on any kind of rebound from those who got caught. They didn't sell up here. They're wishing they could, and so as the stock rebounds, it's like, well, I know I'm not going to get all my money back, but I'll get as much of it as I can. And then the stock starts rolling over. So that's what I think. That's what I'm looking for, is a failure actually below the 50-day moving average. And if we get that, then the cool thing is you've got your risk well defined, because you can set a buy stop right up here above, say, 230 bucks. And the only way that stop is going to be hit is if the stock actually recovers above its 50-day moving average. And so look for, hopefully, you get a little bit more upside even tomorrow, though the stock does look like it's kind of failed. You short the stock, and then, look for 5, 10, 15 points, something like that. So anyway, hope this helps. Members, again, check out our Trading the Open Tomorrow webinar. Last time we did this was in August. Stamps had taken a big drop here, right down to the 200-day moving average. A lot of our traders bought that and made over 20 points on the day. So it's definitely worth your while if you want to learn how to trade the open.